same price, even if Nifty stays at the same price, okay, the speed of reduction is going to increase. Yes, can you see? Here it reduced by 20 rupees. Here it reduced by 30 rupees. Here it has started reducing by 40 rupees. Okay, the speed of decay is going to increase. That is the reason. Okay. Yeah, it is pretty simple, obviously it's our worst enemy. Yeah, when you're a buyer of options, theta is going to be, time is going to be your enemy. Okay, you're going to fight against time. When you're a seller of options, theta is God, not even your best friend. Theta is going to be God. Okay, theta is God for option sellers. Being a best friend is a very small thing. Okay, when you're option buying, see that it is 30 to 45 days far. The expiry should be 30 to 45 days far. 45 days is there, but you should get liquidity. At 30 days far, see, 31st August is how many days far? 31st August is how many days far? You tell me. 31st August, how do I calculate? 7 days, 14 days, 21, 28, plus 10, 38, 36, 37, 38, 39, 40, 41, 42, 43, 44, 45, 46. 45, 46 days almost. Yeah. So does it fit? Does it fit this criteria? Yes. So this is written hard. This is written hardcore. This is written like a rule over here. But over here, we have to understand this. I have written. Why have I written this? We need to understand that. Yes, the rule is to be above 30 days to 45 days. But here, why did I take 30 days? Because I don't want the option to become zero very fast. It should have some life. Okay, it should have some shelf life. If you go to a grocery store, there are two biscuits. One is going to expire in 1 month, and the same biscuit, yeah, is fresh and it's going to expire after 6 months. So obviously you're going to pick up that, right? Which is going to expire after 6 months. Clear? Because you're a buyer of biscuit. If you're a seller of biscuit, which you want to sell first? You tell me. If you own a grocery store, which biscuit you want to sell first? Which is going to expire fast? Close is going to expire first, or the biscuit which is going to expire after 6 months? Yes. You want to you want to sell the biscuit first, which is going to expire. Why? Because once the expiry edition is gone, it will have no value. All right. So if you are a buyer in the same grocery store, if you are a buyer, you want to buy the biscuit which has a longer expiry so that that biscuit stays in your storeroom. All right. It doesn't become zero. Clear? Clear? Very, very clear. Yeah, medicines, biscuit, same thing. All right. So options is not that far from real life. If you compare everything with real life, you will have some or the other connection. Okay. Chalo. If you're selling options, see that it is the nearest expiry. If nearest expiry doesn't have any premium, then go for second week expiry or go for expiry which is below 30 days. Okay, now it is already Monday. Monday is already gone. There's only Tuesday, Wednesday, Thursday left. So obviously you're not going to find any premiums. So go for 27 July, right? The next expiry, which is called. So theta only affects time value portion of option. Buying options lessen exposure of time decay. Selling options maximize exposure of time decay. When you buy ATM or slightly ITM, and when you're selling, see that you're selling OTM. Remember that packet of chips? Remember the packet of chips? When we are buying, I want some little chips inside the packet. And when I'm selling, I want to sell maximum air possible. Clear? Yeah, this is just a callback to the old rule. Okay, when we are buying, we will buy slightly ITM, and when we sell, we will sell OTM. Okay. All right. So let's take a break. Let's take a break, and then there is a very small topic, but very, very important topic of non-directional strategy. Or do you want me to continue? We'll complete in the next. Where to see IndiaVix just loaded like a stock. We sell options of demand. First thing, demand zone. We sell options of supply zone. All right. We are seller of a call and we are seller of a put, and the stock expires. So your out of the money call is going to become what? If Nifty expires below the strike price, is going to become 0. And what if Nifty expires above the sold put? Above the put? Nifty expires above the put, it is going to become 0. So what is our motive over here? We want to eat away the premiums. Yes or no? We want to eat away the premium of call also and put also. So we are going to be seller of calls and we are going to be seller of puts. Okay. Together we will sell call also, we will sell put also, both. And Nifty will stay in a range, and we will eat away the premium of call also, and we will eat away the premium of put also. Okay. Chalo. So loss will occur when the script will break the range. Loss will occur when the demand zone or supply zone is broken. Because if you are a seller of a call over here, yeah, and over here you're a seller of a put, yeah, and Nifty crashes down. So what is your put going to do? What is your sold put going to happen with your sold put? What is going to happen with your sold put? Your sold put at the bottom will have unlimited loss, and your sold call will happen what will happen with your sold call at the above? At the top, what will happen with your sold call? Limited profit. Okay, clear? The only profit you will gain if the Nifty crashes down like this, breaks your demand zone and goes down, will be your only profit on the call will be the premium, and the sold put will go into an unlimited loss. Okay. You can take advantage of range bound stocks, can be planned for weekly expiries and monthly expiries. You can plan for weekly expiry also, and you can plan for near month expiry also. Okay. It is limited risk with hedging. I will show you this, how you can hedge your position. By the way, talking about hedge, if I have sold a call, where is my unlimited risk? This is my supply zone. I have sold an OTM call. Where is my unlimited risk? No, Prashant, it will break the flow very bad, and other students will get disturbed a lot. Okay, so yeah, I need to follow protocols. Okay, where will be the unlimited loss of the sold call? Think from a buyer perspective, buyer of a call. Where will he have unlimited profit? If you have bought the call, where will you have unlimited profit? If it goes up. So if you have sold the same call, if you are seller of that same call, where is going to be your unlimited loss? Unlimited loss is going to be on the upside. Yes. So on the upside, what can you do on the upside that after a point your loss gets capped? On the upside, what can you do if you have sold a call and Nifty is going up, up, up? You're going into an unlimited loss. What can you do over here so that you start making unlimited profit and you can cap your loss? Buying a put is not going to help. Selling a put also, you are already selling a put. Selling a put is just going to give you limited profit. But this call is going to go into an unlimited loss. So we need something at the top which will also make unlimited profit and it will cap the loss of this call. Put a stop loss. Arey, very nice. But other than stop loss, stop loss is there. Fantastic. Like that is the ultimate. But what about without stop loss? Suppose there is a gap. Suppose there is a gap up. Is going to skip your stop loss and going to go up. So we are going to be a buyer of a call. So if I'm selling, suppose 20,000 call, what will I buy? Will I buy 19,900 call? Will I buy 19,900 call? No, I am going to buy 20,500 or 20,300 or whatever. Okay, 700. Okay, or 21,000. All right. So anything above 20,000, I will buy for protection so that my this 20,000 call doesn't start going into unlimited loss. Okay. You are selling a 20,000 call. Okay. Nifty has gone to say 22,000, for example. How much are you going to lose? How much are you going to lose? You're going to lose 2,000. But if you buy a call of say 20,500, yeah, will this also make money? Will this call also start making money? Yes or no? If you buy for protection. Yes. So we will buy a more out of the money call for protection. Okay. So limited risk with hedging. Now, it is easy to identify such opportunities every month. All right. Short triangle, the most common strategy in the world, the most renowned strategy in the world. Short triangle. Okay, we sell an out of the money call and we sell the out of the money put. At the bottom, we sell the out of the money put. At the top, we sell out of the money call. There is limited profit, unlimited loss if range breaks or if there is a huge gap up or a gap down. Clear? Your delta is neutral. Why delta is neutral? Why delta is neutral? Can someone give me the figures? Why delta is neutral? If I am selling a 0.25 delta, I will also be selling a 0.25 delta of put. But this became 0.5 minus 0.5. How does this become neutral? How did this become neutral? How did this become neutral? If you are a seller of a call, your delta is negative. If you're seller of a put, your delta is positive. All right. So negative 0.26, for example, and positive 0.26, for example. This will make your delta neutral. It's not called bidirectional. It's called non-directional. It's called non-directional. Non-directional means we are expecting Nifty to be in a range and expire. Okay, so this is called non-directional. Bidirectional means you want Nifty to go up or down drastically. You don't know where it will go, but it will definitely go either up drastically or down drastically. That is called bidirectional. Okay. So limited profit, obviously, and unlimited loss if the range breaks. Theta is positive. Why theta is positive? Any specific reason why theta is positive? Any reason why theta is positive? Because we are seller of options. We are option writers. We are seller of options. We want it to become zero as soon as possible. We want time to fly. Yes? Yes or no? Time is our best friend. Time is God for option sellers. All right? The faster the time goes, the faster your premiums are going to decay. Okay, so this is a picture of a range bound stock. Now Nifty is right now not in a range bound mode. It is in a super bullish mode. Okay, so if you see something like this, you see a supply zone and you see a demand zone. Yeah, and Nifty is in the between. You can go for selling a call at the top and you can go for selling a put at the bottom. Okay, clear? Yeah, so you do not need to wait for price to come into a demand zone or supply zone. Yeah, if Nifty is in between, anywhere in between the supply zone and demand zone, you can go ahead and sell the call above the stop loss of the supply zone and the put below the stop loss of the demand zone. Okay. Yeah, we'll take an example, obviously. We'll take an historical example because right now, Nifty only bull call spreads are being made on Nifty right now. All right. So this is a supply zone on Nifty and this is a demand zone on Nifty. Okay, can you see this? Can you see this? Yeah, this is your supply zone and this is your demand zone. Now when Nifty formed this demand and Nifty already had the supply and Nifty formed this demand. Yeah, I sold a call over here. Let me use my marker. And now you will tell me which strike did I sell and of the call and of the put. Sure. Over here, think from ATM. Always start with ATM. It's going to help you. Over here, which call did I sell? Over here, which call did I sell? Think from an ATM perspective and we need to sell OTM call. Above the stop loss. 19,600 call. Very nice. Okay, sold. Clear. And over here, which put will I sell over here? 19,300. Very nice. Or 19,250. 19,300, 19,250, both are okay. Here, both are fine. For example, we'll take 19,300. Okay. Clear. When this becomes range bound and it will expire. Before it goes up, it expires over here and we make money. Clear? Yes, this is our agenda of making money in a non-directional pattern of a Nifty. All right. Bank Nifty, see, Bank Nifty was in a non-directional, it was range bound. Look how it has been range bound for so many days. For so many days, Bank Nifty was range bound. Yeah, till today, until today, it was so many days, it was range bound. Okay, Bank Nifty. So what strike would have you sold on the top? For example, over here, when Nifty was over here, this demand was already there. When it created this supply, what strike you would have sold? 45, 500 call. Very nice. Sell. And over here, 44, 200 or 44, 100. All right. Here, very nice. Roshan, what you did not understand specifically, strike selection or demand supply or what? I must have missed your chat. So just type it again. I don't mind answering you. Yes, we'll come to margin also. Don't worry. Yes, I'm coming to that. Roshan, I'm coming to that. No, it should be out of the money. It should be out of the money of both the stop losses. The supply zone stop loss, it should be above the stop loss, and put should be below the stop loss of the demand zone. No, Subramanian, no. Vikrant, I'm coming to that. I will come to that, Roshan. I'm coming to that. We are coming to iron condor now. So iron condor is nothing but short triangle with protection. Okay. Yes, I will share the Excel, Ankit. Don't worry. So when view is range bound, when your view is range bound, you do a short triangle. What is an iron condor? What is an iron condor? Yeah, we sell the OTM call and OTM put. All right. Yeah, we sell the OTM call and OTM put. We buy the OTM call and OTM put. Here your risk is limited. From unlimited risk, you have converted to limited risk, and your reward is also limited. Delta again becomes neutral, theta is positive. Limited profit, limited loss. Okay, call and put options bought, which will act as your hedge, which will act as your protection. Limited downside risk if there is a huge gap down or there is a 1,000 points, 1,500 points, 2,000 points gap down. Your bought put will protect you. And if there is a huge gap up, 1,000 points, 1,500 points, your bought call protection on the upside, what call you have bought for protection will help you to protect. Which protection premium prices will you buy? Now suppose, for example, I have sold 60 rupees, suppose your call premium is 60 rupees and your put premium is say 65 rupees. So how much rupees premium will I buy on the upside? How much rupees premium will I buy on the upside? What 5 rupees? 1/3 of this 60, 20 rupees premium. And here also around 25, 20 to 25 rupees premium. All right. Clear? Clear? Yeah. So your premium, if you're selling premium around 60, 70, for example, you will buy 20, 25 rupees premium for protection. Okay. Your strike price will be defined. Your strike price selection will depend on the premium. So which is your anchor unit? That is the main unit what you have sold, and your offset unit is the protection. Okay. Your anchor unit is your main unit that you have sold, and your offset unit is your protection on the downside. Now, important considerations to avoid doing the strategy close to any important event. If there is a RBI policy, there is a Fed rate, or there is some important, there is budget, for example. Yeah, so avoid doing these kind of non-directional strategies. Why? Because there can be a huge gap up or a huge gap down, or Nifty might become violent that day. Okay, it can be very, very violent, and the volatility can increase. Okay, strike selection is the key. Iron condor more preferable than short triangle. Yes, iron condor is more preferable than short triangle. Ideal for weekly expiries. You can start trading in weekly expiries. All right. Yeah, we'll take an example. Don't worry. Now this is 27 July, for example. Okay, I am selling this 19500 put. I am selling this 19500 put. Okay, for example, I sell the 19500 put. Okay, and I sell the which it should be equidistant. Because if it is 750 and this is 500, it should be around 20,000. So, and this depends on your demand zone, supply zone. Okay, your strike selection will depend on your demand zone and supply zone. Okay, I'm taking an example of 19900, for example, over here. Okay, now suppose I sell this. What is going to be the margin requirement? What is going to be the margin requirement? You can check over here. But first thing, let me check the profit. 57 and 57. 57 and 57. Here's my notes. At 57 rupees. Over here at say 56 rupees. All right. Into 50 is equal to how much? Is equal to how much? 57 into 50 is 2850. Into 50 is equal to 2800. Okay, so what is my total or max profit or total premium received? I650. All right, 5650. So let's go to tools and let's go to span calculator. And we'll make this as sell, add script, Nifty calls and puts, 19500 put. Oh, this expiry is what? 27 July. Okay. 19500 put, add to grid, and 19900 call, for example, and add to grid. Let's check. You have to put the correct one. 19900 call, 27 July. It's okay. 19500 put, 27 July. It's okay. Sell. What is the margin required? What is the margin required? 1,29,000. Margin required for executing this trade is approx 1,30,000. Okay. Therefore, my return or my ROC is approx is equal to how much? 5650 divided by 1,30,000 into 100 is around 4.3%. Is approximately 4.3%. All right. How much money will I make by making an investment of 1,30,000? What is my potential return? This is in rupees. Okay, this is in rupees. Yeah, but what if What if I buy premiums? What if I buy premiums? If I'm selling this, which premium I need to buy? Which premium I need to buy? Which strike price will I buy? 57 divided by 3. 19 rupees. So let's see, 19 rupees is nearer over here or over there. Okay, this is how far? This 19 rupees is how far? 100 points, 200 points. 200 points away. So I'll buy the 20,100 call. Okay, the same thing. I'll copy it over here. Right. Now for protection, I will first buy and then sell. So what I will buy? I buy the 2100 call. Let's type plus over here. Same expiry 27 July. And how much rupees? How much rupees is it available for? 17 rupees. That's 17 rupees. All right. X50 is equal to how much will I spend? How much will I spend on expiry? Oh, sorry, on my protection. How much will I spend on the call? 850 rupees. All right. And I buy the, which strike will I buy over here? Which strike will I buy over here? If I have sold the 19,500 put, which strike will I buy for protection? No. No. It will not be 19,100. No. It will not be 19,050. It will not be 19,000. It will not be any of these strikes. This 19,900 and 2,100, 20,100. How far it is from each other? How far are they from each other? Yeah. So if I'm selling the 19,500 put, which strike will I sell? Or which strike will I buy? If I'm selling the 19,500 put, which strike will I buy for protection? No matter whatever the premium is, I will maintain the same distance. I will maintain the same protection distance even if I have to pay more premium. Okay. I buy the 19,300 put 27 July at 30 rupees. Okay. Which is equal to how much? 30 into 50 is 1,500 rupees. Okay. So total premium. So what is my total expense? So what is my total expense? Total premium received is equal to 2,850 plus 2,800 minus 850 minus 1,500, which is equal to, because these two are insurance, na? These two are my insurance. They will help me from unlimited. So these two are my expense. So what is the total? 5,650 minus 850 minus 1,500, 3,300. Yes. Yes or no? Is it correct or have I made a mistake? Is it correct or have I made a mistake? Let me check. Yeah, this is 2,850. 2,850 plus 2,800 minus 850 minus 30 minus 1,500. 3,300. That's fine. So what is the moral of the story? What is the moral of the story over here? By buying protection, I'm going to earn less. Yes or no? By buying protection, I'm going to earn less money. Yes or no? Because the total premium has reduced, na? Because I spent money on protection. Total amount what I had got to was going to earn has reduced. So let's check. Let's put in the span calculator. Span calculator. Add script. Let's add the call. This is sell. Add to grid. And add script. Let's add the 19,500 put. Add to grid. Calculate. Yes, 1,30,000. Add script. Which call are we buying? We are buying 100, right? And this will become buy. Add to grid. Add script. And we are buying the 19,300 put, right? Add to grid. So will if I press calculate, what should happen? Just look at the magic. What is the capital required now? What is the capital required now? What is the capital required after buying insurance, after buying protection? And in options traders language, I have hedged my position. Now my position is hedged by only 200 points distance. So even if Nifty crashes by 1000 points, 1500 points, my risk is only 200 points minus the premium received. So only around 150 points. And what is my capital required? Only 60,000. Yes or no? Only 60,000. So now I'll write it over here. Margin required for executing this trade is approx 60,000. Yes. Therefore, my ROC is approx how much? It should reduce. It should become 4.1%. It should become 3%. It should become 2%. Come on, tell me. So my max profit is 3,300 divided by 60,000 into 100, which is 5.5%. Yes. Now tell me which is more suitable. You want to go for unlimited risk without protection, or you want to go for hedge protection and earn more return on capital? So friends, after 2020, the Securities and Exchange Board of India and NSE came together and they decided to reduce the margins in options selling, especially if your positions are hedged. Yes, this had come into circulation after 2020. Okay, so now if you hedge your positions and make the same trade, your requirement goes down and your return slightly increases instead of decreasing. Yes. So how many lots can I do? I can do 2 lots with the same capital. Yes or no? I can do 2 quantity or 2 lots with the same capital, and instead of making 5,600, I will make 6,000 rupees. Yes. So you're making more return by hedging your position. By even taking insurance also, you're getting more return. So nothing like it in the world. This is the reason why iron condor has become now more popular than short strangle. Okay. Right, want me to copy this? We can copy this. I don't mind. I have not yet created the formula. I will create it now, so don't worry. Yeah, just take me seconds to do that, because it is current market price minus strike price, right? Simple. I'm done. Okay. Will change, obviously. I didn't get time in the break, no, that's why. Okay, sure. I'll just share the sheet with you and you guys can understand. Oops, what happened? This is your buy and this is your sell. Okay, this you have bought, this you have sold. You have bought for 490 at 879. It's going to be 379. And if you have sold this, this should become 0, right? So if current market price minus your strike price is less than 0, what will be the max loss on iron condor? What will be the max loss on iron condor? It is the distance between 2 strikes minus the premium received. Okay, I'll just write it down over here. Yeah. Max loss is the distance between the anchor unit and offset unit minus the premium received. Okay, this is going to be your max loss. Simple. The distance between the both the strike price, the distance between 19,900 and 20,100 minus the total premium received. Total, obviously total. All right. So people who want to exit can exit. Yeah, and if you want to wait for the notes, just give me 2 minutes. I'm trying to rectify for a bull call spread so that you can put your own strikes over here and play around with the premium. Okay, this has gone into an unlimited loss. This should have gone into an unlimited, limited profit on the, no, this is correct. This is correct. Just give me 1 second. Why did you take premium of 30 instead of 17? Because I want the strikes to be equidistant. I have sold the 19,900 call and I have bought the 20,100 call. So over here also, I want it to be only 200 points away. I want this to be only 200 points away. It should be equidistant. Yes, your protection should be equidistant. All right. Clear? Okay, so this sheet, Excel sheet is ready for the bull call spread. If you just put in your strikes, for example, let's make a bull call spread of say 19,600, which is 210, 19,600, which is 210, and 19,800, which is 94, 19,800, which is 90. Okay, so you start making money above 19,700. That's correct. 19,800. That's correct. There is a limited loss and limited profit. Fantastic. Okay. So I'll just share this file with you. Just save it. And yeah, I also pasted this, so you won't have any problem. Yeah, just give me 1 second and I'll share the notes with you. In the time being, you can ask me your queries. I'm still here for the 5-10 minutes more. Notes. Is this saved? Yes. Okay, so I have sent the notes file. Please click the dots button and save it, or you can click on the green icon and download it. No, you cannot execute from the calculator window. No. Which calculator window? You're talking about the span calculator? No, you cannot execute from the span calculator. No. PPT is there. PPT is already there in study material. Can you calculate max loss of? I've written over here for any. I have already written in the notes the max loss of iron condor. The max loss of iron condor is always going to be the distance between the sold unit and the bought unit minus the premium received. Okay. How to snap all futures to Excel? What do you mean by that? You want all the futures price in Excel? It's very simple. What's the big deal? Let's go to this near futures. Let's go to near futures, right click. Where is snap to Excel and new snap? Done. All your future price will show you, will give you live prices. Excel will start giving you live market prices. The prices of it will be moving in the live market. Your Excel prices also will start moving. You will get live prices in Excel. All 200 futures are not coming. Then you need to contact your relationship manager at Sharekhan broker branch, at your broker branch of Sharekhan. Okay. We have to execute from option chain. You can execute from option chain. I prefer option chain because it is easy. See, if I want to execute this strategy, I will go here, select this. First, select the buy unit, click buy, place, confirm. Then go to 300, simple, soft, and click and place and confirm. Go to 500, sell, place, confirm. Go to 19900, sell, place, confirm. Slowly take a breath and then place the order. Yes, it will not take you more than 10 to 15 seconds if you use the option chain. If you're not comfortable with option chain, just select a market watch, create a market watch, add all the strikes over here. First add the buy strikes. Okay. Your 20,100 is going to be the buy strike. Your 19,300 is going to be the buy strike. Leave some space. Yeah, and then add the sell strikes, your main strikes. Yeah, 19,900 call, add, and 19,500 put, add. Okay, so very easy. Just buy, place, confirm, select, buy, place, confirm, select, sell, place, confirm, select, sell, place, confirm. Done. How did you add space? Control B, Control B, Control B, B for ball. You can see, you can hear it is right click, add blank row, right click, add blank row. No, Prashant, no. If we put all four, yes, margin problem may come, yes. So it is very simple just to do, just execute the buy units first and then execute the sell units. Because if you execute the sell units first, it is going to ask you for 1,30,000 margin first. And then when you buy this, then your margin will reduce to 60,000. So this, your order will get rejected. If you have 1 lakh rupees in your account, selling this, your order will get rejected. But if you buy this first and then sell this, your order won't get rejected. VIX, see, I have added India VIX over here. I have added India VIX over here, so I don't have to add it again and again in the market watch. But if you want to add it to market watch, just go to add script, go to equity, and just type India VIX. You have to select NSE. Yeah? BSE, you will not get India VIX. You have to select NSE, then only you will get India VIX. Okay. And if you want to put it on the title bar over here, just go to edit button and select whichever you want. And same way, just select India VIX. For example, I'll select Tata Motors over here. Add, apply, and here Tata Motors will come. Okay, I'll just change this to India VIX, otherwise I'll get confused. Okay, India VIX, apply, and you will get India VIX over here. Manually. You have to execute and you have to exit manually, target or profit, whatever. Only 4. You can add only 4. Okay, Rahul, I'll share the notes again. Don't worry. You can see it, na? If you can see it in your turnover, if you're making profit or not. Okay. Yes, of course, it will show in order book. Yes, either you can wait for expiry, or if you're getting 70, 80, 90% of the premium, you can still exit. Okay, ideally we wait for expiry, but if you can come out, you can exit 1 day before expiry. You can exit 1 day before expiry. Yeah, you can exit 1 day before expiry. Or if you have got 70, 80, 90% of your premium, you can then also you can exit. That's a good way to exit. Either 1 day before, or if you have received around 75 to 90% of your premium. Yeah, while exiting, you have to exit your sell units first. While exiting, always remember sell unit first while exiting. Then exit. Then you have to exit your buy units. Okay, you have to do ulta. When entering, you have to enter the buy units first, sell units later, and when exiting, sell units exit first and buy units later. Okay. Payoff graph is AOC and portfolio Greek watch. And then add your script over here. For example, Nifty, add script. Okay, then add whichever script you want over here. Okay, add, and then you can reduce the quantity to 1, and then you can see the payoff graph. Okay. Yes, TZI I have taught in equity class. Yes, trading 102 class, TZI has been taught over there. So you have to use that and create your trades. Yeah, you can do square of all. That is fine. You can do square of all, but first I would recommend first exit the sell units and then exit the buy units. Okay, chalo.